Yeah, dear Mr. Conradi, thank you for the kind words. Mr. Buck, you have a wonderful congress here, the biggest of its kind in the world. I'm amazed to see the scale of the operation. And I will speak about the world, how we see the business cycle situation currently. And I will speak on Europe. About Europe, which is part of the world. This information amazed us and frightened us in January. It's the collapse of the Chinese stock market. You see this yellow curve, and in the background you see in comparison the collapse of the stock markets after Lehman. Date 0 is in both cases the day of the strongest decline in the stock market. And what you can see here is the development is very similar to how the DAX and the Dow Jones behaved in 2008. Some people say these crises are not comparable and, you know, it's of minor importance. I don't share that view. For China, at least, it's the same, as you see here. There is the sharp decline the first 20 days, then comes a period of consolidation, and hopefully in the end, after 3 months, after 90 days, we won't have another decline of the indicator, which you could expect if you see the right-hand part of this picture. The DAX shows a better performance. It was a shock wave for the DAX too. It's more comparable to the development of the Shanghai index at the time of the Lehman crisis. So the region itself is strongly affected, then others are less impressed, but it's very symmetrical compared to what we had 2008. Only the Dow Jones gives a much better performance, and that gives us hope that this time it will not affect the whole world in a similar way. The E4 World Economic Climate shows that the situation is reasonable, but the expectations for the next 6 months are strongly declining, have been strongly declining for 2 quarters in a row. What is the E4 World Economic Climate? We ask every quarter 1,200 experts sitting in 80 countries of this world about the assessment of the current situation in that country. Typically, it's executives of German companies sitting in these other countries. So it's a very good, and I think the only expectation indicator for various countries of the world that exists. So that's not so good news. Obviously, the world is cooling in the moment. If we see a subset, the BRIC countries, first until 2011, India, Russia, Brazil, and China, and follow it since then, we see that in Brazil we have a true catastrophe. A big bubble has burst. It's in a big crisis. Hopefully, possibly, the bottom has been reached, but it's very low. And for obvious reasons, Russia is in deep trouble because of the sanctions by the West and the low energy prices. And China is coming down. I will speak about that. India, which had a very good performance in 2014, also came down in 2015. 1, 2, 3, 4 quarters in a row, we had declining indicator values. So that gives rise to concern. The emerging countries are currently in a slump. Let's look at China more precisely. You see that the growth rate is coming down. The peak here in the middle, or the trough, in 2008 is Lehman, but since then, the time of the big growth rates obviously is over. Are these growth rates correct? I don't know. I'm not sure about it. What irritates me is the separate numbers of Chinese exports and imports. The exports came down by 11% from January to January, so the Chinese have obviously problems with their markets, where they sell, Asian markets. And the imports came down even by 19%. And that tells me that there's something wrong in the statistics. It is impossible, in my opinion, that we have such a strong decline in imports while the economy is still growing. There have always been suspicions that the numbers are not quite right, which have officially been published, and I would say this confirms this. So imports decline can come through declining commodity prices, yes, but that's only a small aspect of this picture. Otherwise, it's a collapse of the economy. We have seen such import declines in Southern Europe all over the place because the economy is collapsed. Russia, well, is affected by the low energy prices. For example, here the oil price, which was only $30 a barrel, and that's a major problem. All the commodity prices have come down. United States, here the situation is much, much better. You see Lehman is only a little deviation from the trend, and the US is now way above the pre-crisis level of GDP and keeps growing. The unemployment rate in the United States has been coming down since 2010 and is now on a very low level of 5%. Europe. The current economic situation is assessed still quite good. This is the first quarter of 2016 where we have the data. But the expectations have also come down in Europe, reflecting this uncertainty in the world economy for 3 quarters in a row. The expectations have come down, and that means that the economic situation will likely also deteriorate in Europe. In Germany, we have an even better indicator than the World Economic Survey. We asked 7,000 firms about their current situation and about the expectations. And this is the net result of both. And it shows that here we had a decline 3 times in a row. Well, the first time is hardly visible here, say 2 months in a row. And the decline is sharp. We said the German economy has been frightened by the events in the stock markets and looks with uncertainty into the current year. We see a similar thing here with the export expectations. Of course, it's not a decline which resembles in any way the Lehman decline. We are not in a similar situation, but exports are also under threat. Germany sells its products to the whole world, including the emerging markets, and if they are all coming down, this is reflected in the export expectations. Selling to America is no full compensation, in particular since the American market for German cars has been handicapped for reasons you know. But the German construction boom is still on the way. We have a rather reasonable development here, which results from the economic crisis. You may wonder why a crisis can create a boom. Typically, a crisis creates a recession or not a boom, but this time it's different because of the capital market. German investors, savers, financial institutions don't dare to bring the savings capital abroad anymore. 10 years, 12 years ago, Germany was in deep trouble and was forced to carry out painful labor market reforms, depriving millions of Germans of their social entitlements, to widen the wage distribution and allow a low-wage sector to be established. That time is over. At that time, savers, investors were looking abroad. The gold seemed to glitter more everywhere in the world than in Germany. They bought American structured securities. They invested directly in Eastern Europe, where the wages were so low. There was a lot of investment in China and in Southern Europe, but no longer. No longer. One knows that these structured investment products, asset-backed securities, were basically faked financial products where you had bought claims against claims against claims against claims up to 40 times over, where in the end you had a claim against a little hut somewhere in the prairies, which was worthless. That has led to lots of write-off losses for German financial institutions. The Landesbanken came into deep trouble, had to be rescued, and by now no one is interested anymore in such products. And what about government bonds in Southern Europe? A similar thing. These bonds seem much more risky than they appear to. What about banks of the north lending to the south, to southern banks? Well, you know how the Italian banking situation is. We have hundreds of billions of non-performing loans in the bank balance sheets, and quite a number of banks are at the brink of bankruptcy and now need to be rescued with all sorts of tricky operations by the Italian state and the European Central Bank. So in such a situation, savers and investors don't dare leaving the country. There is a flight into the beton gold, or concrete gold, as we say in Germany. They go into real estate in Germany because there they seem to be safe. And that creates a real estate boom, and the real estate boom creates lots of construction activity. There are lots of jobs for ordinary people, handicraft, vocational jobs, and that drives the entire labor market in Germany. So since 2010, we have an internal interior boom, which is one of the reasons why Germany is the goal of these refugees. You know, the refugee migration inside the EU is a pure economic migration. First comes the flight from the home country, from Syria, say, to Turkey, and the rest is economic. The people go to that country which offers them the best conditions in terms of social welfare and in terms of job availability. And in both regards, Germany is currently an attractive place. And it is so because of the construction boom that we have. It goes on. This is the stock of unfilled orders of freelance architects. And you see on the left-hand side of the picture, that's the fall of the Iron Curtain, when we had lots of construction activity in Eastern Germany. Then there was a long decline until 2003, and from then on, it's an ongoing improvement. We have a construction activity or a stock of unfilled orders here, like in 1994 when we had the unification boom in Germany. The ECB now tries its best to get the European economy going. You know, it bought government bonds for 223 billion euros of the crisis countries. All central banks were forced to buy the government bonds of the southern European states, including and Ireland, for 223 billion. Then that was not enough. Then the ECB said, oh, we will continue that policy under slightly changed conditions in an unlimited way, whatever it takes, the OMT program, which is a free of charge CDS insurance for purchasers of government bonds of crisis countries. These purchasers could insure themselves if they wished so by buying CDS insurance in the market. Then they pay an expensive premium, but they could also, they don't have to do that because Mario Draghi is insuring them free of charge currently, which is a major subsidy of savings flows from the north to the south. So that should help. And now the ECB is even in the QE program. It wants to buy for 1,200 billion euros assets, typically government bonds, in a symmetric fashion from all countries in the Eurozone, and is pumping lots of money into the economy. Well, this has an effect. It has an effect on the exchange rate, an enormous effect. The euro has devalued, and this devaluation has made the euros extremely cheap in relationship to America. In order to assess the exchange rate, it is useful to look at the purchasing power parity. The purchasing power parity is an artificial exchange rate. It's now standing at 129, which makes a basket of goods equally expensive in Europe on average as in America. Anything below that makes Europe cheaper and America more expensive. Well, there is a natural band because the countries of Europe are not in a similar positions. Some countries are more expensive than others. If you consider the 10% most expensive countries that exist in the Eurozone and ask what exchange rate would make them as expensive as the average of the United States of America, you would get this number, 114. And if you consider the 10% cheapest economies in the Eurozone and ask what exchange rate would make them as expensive as the average of the United States of America, you get that number, that's 161. So these two margins define a natural scope for the exchange rate. And where is the exchange rate actually? This is the true exchange rate. You see it's now lower than the lower bound. That is, even the most expensive places in Europe are cheaper than the United States on average, which should have an implication for tourism, insofar as one would hope that the American tourists now come to Europe to enjoy the low prices. It is not as extreme as it was in the 60s. I remember that when the Deutschmark, the 4 Deutschmarks were needed to buy $1, then huge crowds of American tourists came to Europe, to Germany, to spend their holiday there because everything was so wonderfully cheap. But it goes a little bit into this direction. So. Those of you which have not done so should contact your American peers and ask them whether you could offer them good deals here in Europe. After all, Europe is much more beautiful than the United States anyway, and therefore they should come. The economic development gets a boost through this policy of the ECB because everything is so cheap, so exports should get up, and that should be a stimulus for the European economy. Here you see the growth rate, the growth of Germany in terms of standardized GDP level in real terms. The dot here by the end of 2007 is the pre-crisis level, and Germany is now 5.5% above the pre-crisis level, pre-Lehman level. What about the other European countries? This is France. France has just managed to get above the pre-crisis level, but it has not been performing very well during this crisis. This is Spain. It's still 4% below. It will, for Spain, probably take a decade until the effects of this crisis are overcome in terms of real GDP. Not from now, I mean from the beginning. Most of the time is over. And this is Portugal, slightly worse than Spain. And this is poor Italy, which is still 9% below the pre-crisis level. Italy is truly a catastrophe in terms of economic development. One would think that the Italians now become cheaper, that they reduce their wages at least relative to the rest, so that their price level can decline relative to the West, but they don't. Italy has inflated, like the rest of the Eurozone, throughout the crisis, a completely abnormal behavior, while Greece and Spain have really come down with their relative prices and are much more attractive places for tourism now. Italy has done nothing whatsoever, like Portugal has also done nothing in this regard, even though there was a severe crisis. Yeah, and this is Greece. No comment. Greece is a failed state. I quote here Yanis Varoufakis. This is not only my judgment. Nothing seems to work. The state doesn't work and the economy collapses. There's no way for Greece, in my opinion, to survive in the Eurozone. And here we have Ireland. Ireland is doing very well. The Celtic tiger is showing again its strength. Mind, this is GDP. GDP includes the competitive sector of traded goods plus the non-competitive sector, the non-traded goods sector of internal goods like construction activity and services and what have you. While even services, as you know, are tradable through tourism, but not so much. Let's look at the manufacturing sector. There, everything is a little bit more gloomy. Germany has still not yet reached the pre-crisis level, or has just reached it, you could say. Portugal is 11% down relative to the pre-crisis level. France is 15% down. And the problem of the French economy you see here even more clearly than when you look at GDP, because GDP you can always make grow by pumping government credit into the economy. The government borrows and buys some goods, and then you have some activity, and that you can measure as GDP. You could even increase the wages of the government employees, and that is counted as a GDP increase. So it's a little bit faked, it's not real. But the manufacturing sector figures are much more real because these are sectors which are truly in international competition, and France is not performing well. Since 2011, France is lingering on, has been lingering on. Here, Italy, 24% below the before crisis level. Renzi is talking a lot. Period. No result. Because talking and carrying out painful social reforms that with brutal force bring the wages down in order to make the country more competitive are two completely different things. So he wants to borrow in order to create a little bit of government demand, this artificial demand. But the more government demand you create, the more you undermine the competitiveness of your economy, because then everyone concentrates on the wrong things. No? And here is Spain, which has been improving, but is on the Italian level, and Greece. And here is our Celtic tiger with 48% increase in manufacturing output. Unemployment rates show a similar picture. Here you see the German euro crisis 10 years ago, little noticed outside Germany, interestingly, because everyone notices the crisis in Southern Europe now, but no one noticed the similar crisis in Germany at that time. And here we have France. Here we have Ireland. Here we have Italy, Portugal, Spain, and Greece. Yes, the situation in Spain and Greece seems to be improving a little bit, but the level of unemployment is still very high, and the youth unemployment rate would be even worse with 50%. That pain resulting from this mass unemployment drives people to radical parties. We have seen that in Greece, we have seen that in Spain, we have seen it in Portugal, and we may see it in Italy and may see it in France at some stage. And that is the true uncertainty about Europe. It doesn't come really from the economy. You can pour money at these economies through rescue programs, through artificial interest reductions, through ECB operations, and so on. But that does not really reach the population, as you see here. The consumer sentiment is still by and large okay due to the government-induced demand programs. If we look here at tourist accommodation in the EU on average from 2004 onwards, there is a slightly improving trend despite the crisis, but not in Italy. Germany is now on a level as it was more than 10 years ago. Its crisis has been overcome and things are normalizing now. That is Spain. You see the crisis until 2013, 2014 is an improvement, which partly results from the difficulties in Northern Africa. It results from the difficulties in Greece, because Greece will not be a primary destiny or place for tourism this year. I guess you should know that better, because people are afraid of being in confrontation with floods of refugees. They will go to Spain and other places. This is Austria, UK, Ireland, and Greece, where the tourism has come down up to the crisis 2012 and is now on a level which is still much higher than in 2004, but will probably decline. And similar for France. And here we have some neglected countries. I could show you more in Eastern Europe, which started at 0 and therefore have this high growth. This is not the level. This is the growth from 2004 onward. Another aspect of the crisis is residential property prices. You see here that if you begin in 1995 at the Madrid summit when the euro was agreed and when the interest convergence in Europe took place, we had this enormous construction boom in Greece, which stopped at the time of Lehman, and then the backward gear was taken. The Greek prices have now declined by 40%. Spanish development similar, but they seem to have, the fall has seemed to come to a standstill. Cyprus, whom else do we have? Ireland, Italy. Italy seemed stable for a while until 2011, but is now on the downward trend. And here is Portugal and France. The surprising thing about France is that it obviously had a bubble. From 1995 onward, the price level increased from 40 to 100, so by a factor of 2.5. It more than doubled. No, it tripled. It more than tripled. And you would expect that this bubble bursting is seen in France, but it isn't. And that's surprising because probably France has so much political power that the interest rates stay low in the country, and therefore it remains attractive to invest in real estate property. Here is Germany. What is interesting about Germany is that property prices stayed constant while the rest of Europe was booming. And now, as the rest of Europe is in recession and has declining house prices, German prices go up. Germany is always the mirror picture of what's happening in the rest of the Eurozone, because the capital can only work in one place. Either it's in Germany or in Southern Europe. It cannot be in both places at the same time. Business cycle developments often depend on commodity exports and imports. If one country goes up, it pulls the other one up too. So the development is like the wings of a bird. But the development in the capital market is more like this. If one country goes up, the other goes down, and vice versa, because capital is only available once. You can invest it here or there, and where you invest it, there's a boom, and it's lacking in the other part. And that's what you see here clearly in the property market. In big cities in Germany, house prices have gone up by 50%, and that, I would say, is the first sign of a property bubble beginning in Germany. And this is the danger of the ECB's policies. It pumps a lot of money into the economy, drives down the interest rates, fine, and then there is the crisis. The capital shies away from Southern Europe, nevertheless, and goes into German real estate, and there it creates a bubble. Every bubble bursts, and so the situation is not without danger. Fortunately, it takes 15 years on average until a bubble bursts, and the first 10 years are usually rather pleasant. So we don't have to be afraid immediately, because only 5 of these 15 years are over. But I would say if we have that development, which we had since 2010 for another 5 years, then we would be entering very dangerous territory. A country which already is in a bubble, even more so than Germany, is Austria, for example. This is a true risk for Europe, because the ECB obviously tries to bring the interest rates to negative territory, as you see here. This is the interest rate on deposit facilities. So if a bank has money, it can hold the money on its account with the local central bank. They have an account, as private people have accounts with their banks, they have an account with the central bank. There they can hold the money, but if they do that, they have to pay a penalty rate of 0.3% now. And the ECB wants to bring this penalty rate even further to negative territory, so as to bring all interest rates further down, the whole spectrum of interest rates, what have you, interest rates for private business, interest rates which governments have to pay, short-term, long-term interest rates, the whole spectrum of rates they want to bring down, and we already have lots of rates which are negative. Government bonds have negative interest rates nowadays, and they would make them even more negative. As an individual in Germany, if you want to have a loan, a mortgage, 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 to have a loan. Thank you. You don't know what that was? Okay, good. So you pay 1.5% or 1.2%, and in the future, the bank may give you money if you do them the favor of borrowing. What kind of world that will be, I don't know. I find this dangerous, and many do so. The BITS, the Bank for International Settlement in Basel, has recently published a report where it expressed its concern about this negative interest policy. But the ECB is determined to go that way. And the next step they are doing is they abolish the 500 euro bills in order to prepare for negative interest rates. Why? Why has this to do with one another? The public debate is this is against criminals. Sorry. Don't believe a word. It has nothing to do with, very little to do with criminals. The point here is that the banks are already preparing to hoard large amounts of euro cash. There are internal preparations by the German banking sector, which I know, to have physical hoarding of cash. And if you abolish the 500 euro bill, and then the banks have to use 200 euro bills, that means that the hoarding cost, the physical hoarding cost, is 2.5 times as large. So if this is 0.3, they would at least be able to go to 0.5 or perhaps 0.75. The hoarding cost is estimated to be 0.2 nowadays. So banks are already beyond the critical level where they prefer to physically hoard the money rather than have the money in the account with the ECB. And this abolishment of the 500 euro bill is a clear preparation for the next move going further into negative territory. Yeah, this is my story. A short glimpse about what happened in the world and Europe. I don't know whether we have time for debate or whether the time is over, but thank you very much for your attention.